Now, I just thought we're very close to levels that we haven't visited in 2018, or we are at levels which we haven't visited in 2018. It's a good time to take stock of how the fall has been, what could be the plausible takeaways from the last 2.5 months of trade that we've seen in 2018. The first chart, I've borrowed it from a Morgan Stanley note which came out on February 26th or February 28th, either of the 2 days. Excuse me for not remembering that. But the Morgan Stanley note says that rich valuations in the broader markets could well lead to corrections, if at all, that come in at the broader end of the spectrum. So the two charts out here, the gray one is the market cap to GDP ex Sensex, and the blue chart is the market cap to GDP including the Sensex. And you can see the difference in valuations, wherein the broader market valuations, according to Morgan Stanley, a lot steeper than the benchmark index valuations. I mean, frankly, everybody's on the same page. And they highlight the factor that the main markets or the mother markets may not necessarily be as expensive as we make it out to be. Moving on to what's happened in the fall thereof. And you will see that the broader market fall has been more pronounced than the large cap fall. This is the returns from the start of year, that is 2018 returns. And while we did go up a bit in the first few days, from there on, from this point onwards, which is about Jan 15, when the corrections almost started at the broader end of the spectrum, year to date, we've lost about 9% and 8% respectively in the mid cap and the small cap pockets. Compare that with what's happened to the Nifty, which is the white line, 2.5% YTD move on the downside, and the Nifty Bank, which is being touted as the culprit for the fall, 4.5%. These guys have corrected almost 3x compared to the Nifty and 2x compared to the Nifty Bank. So the broader market fall has already happened. Not to say that this is the end of it, but what everybody's been talking about, that the broader market valuations were very rich. We're already seeing evidence of that in the difference in the falls that's happened between the large caps and the mid caps. Now, I know we've been talking about how the indices or the Indian indices have fallen a lot more than some of the global indices. Just thought would put that into perspective as well. These are 5 markets. Mind you, I haven't chosen some markets which have corrected more than India too, but these are the 5 markets YTD, and ignore the Bovespa. That's really had a big move, and we all know the reasons, so I won't get into that. So the Bovespa has had a brilliant run. YTD, that's about 9.5%. But then look at this cluster. And in the cluster, it's evident that there are a clutch of markets which have had a move anywhere between 1.5% on the upside to about a couple of percentage points on the downside. So the Nifty is not alone out here. Almost all the markets, emerging markets, Straits Times, Shanghai, Nifty, a couple of other markets too, have fallen. Kospi, for example, has had a fall which is steeper than what the Nifty has been. So while we may say that that Indian markets are not in sync with what the global markets are doing and we are falling a lot more, that need not necessarily be the case. It's a matter of 2-3 percentage points here and there, and it could happen to almost any market. So don't get too perturbed. There is a fall, yes, but it's happening across the markets. I was just looking at 2 or 3 notes that came out very, very recently, 2 or 3 thought points that came out from a bunch of people. And the absolute return letter spoke about made 2 or 3 mentions to why this could be happening. Now, there is a fear of a serious bout of inflation in the US. This is for the US markets, keep that in mind. And a lot of people questioning whether the Fed is really behind the curve. There have been equal number of people, I think Ray Dalio mentioned this as well, that the Fed will be surprised with the quantum of rates that they will have to make. So a bunch of people who believe that the Fed is behind the curve. And if all of this is happening and impacting US markets, comes that famous saying that correlations go to 1 before you can count to 10. And never mind how much we would want to say that, the US has problems of its own and the others may not have so. I think when the mother market falls, almost every other market tends to react, and India and the other emerging markets would not be any different. The valuations are still not bad, but just highlights the point that if the mother market is correcting, we will correct. Last but not the least, what Shraddha was mentioning and what we all know, the recent correction and the kind of fall that it has brought to some of the banking names. I just scanned as to what the returns from 29 Jan, from where the fall started, have been. And the losers list is peppered with rate sensitives. You look at the MRR function on the Bloomberg terminal, and it's filled with banks, corporate-facing banks, select auto names. It has the Axis banks, the ICICI banks, the SBIs of the world, certain auto names as well. So it's all about what's happening. to the rate sensitives. This is year to date really, and that will show Bharti Airtel, Tata Motors and the others too. But if you had looked at from, Giant 29, the clutch of names out there in the banking space, which are a part of this losers list. State Bank of India, there is ICICI Bank, there is Axis Bank amongst that list as well. So no surprise here that banks are at the center of action. But remember, the broader markets have already corrected 8-9% and much more than what the large caps have seen.